So was there something in your education or your research that, other than your dad giving you the gold coin, that kind of helped you understand, hey, they're getting this all wrong? When Keynes said this is a barbaric relic, he just didn't know what he was talking about.
Yeah, no, I don't know. I guess it's like getting religion. It comes to you slowly over time, and and it was, when my grandfather gave me that coin, I definitely wasn't a gold bug, and I was still in the learning stage of my life, and I thought it was a nice gift and pretty, and I'm happy to still have it, but it wasn't. There was nothing that rang the bell that says, God, this is where my future is going to lie.
Welcome to Sterling Insights, Stand Out and Supercharge Your Assets, the go-to podcast for financial advisors aiming to grow their assets under management, stand out in a crowded market, and retain assets nearly forever. Are you advising high net worth clients who own appreciated capital assets? Do you want to help them sell without losing a quarter, a third, or even more of their hard-earned profits to capital gains taxes? Then this podcast is tailored for you. Each episode brings you the latest strategies and expert advice from leading financial advisors, seasoned attorneys, and experienced CPAs. Learn how to maximize your clients' wealth, minimize their taxes, and supercharge your advisory practice with actionable insights. Join us on Sterling Insights, Stand Out and Supercharge Your Assets, where you'll gain the knowledge and tools to set yourself apart and achieve unparalleled success in wealth management. Subscribe now and empower your practice for a brighter, more prosperous future. Welcome to Sterling Insights, Stand Out and Supercharge Your Assets. I'm your host, Roger Silk. Today's guest is John Doody. John is probably the world's leading independent analyst of the gold mining industry. He has a degree in economics from Columbia and an MBA in finance from Boston University. He has done PhD work in economics and taught economics for about 20 years before turning his full-time attention to gold stock analysis. His newsletter, Gold Stock Analyst, ran for 30 years until John attempted, somewhat unsuccessfully, to retire last year, and we will ask him about that. He now publishes John Doody's Fave 5 gold stocks. Since the Fave 5 launched in July, the portfolio is up about 10%, and I'll bet it's more by today. As you know, I've been a subscriber for, I think, since near the beginning of Gold Stock Analyst, at least 20 years or so. I have a pretty good idea of certainly of what you publish, and I think that is probably a distillation of what you think and how you think. But I'd like to ask you if you could kind of, for our audience, if you could give like a short overview of how you approach this space.
You want me to compress 30 years of writing the newsletter into 30 seconds?
Well, you can have 3 minutes.
Okay, great. Well, Gold Stock Analyst, that's the key word. When I started writing the letter in 1994, what encouraged me was that there was a market for people that were buying newsletters written by Jim Dines and Harry Brown and others, but they were really gold bugs. I am a gold bug, but I'm not I'm an analyst first, and I analyze gold mining stocks. And of course, to understand the gold mining stocks, you have to have some knowledge of gold itself. So my contribution to the industry, I guess I like to think, is a very analytical approach towards figuring out what are the best stocks to own. Now, gold, we know, is something you should have anyway, because it's had a track record since 1971, when it was set free by Nixon at $35 an ounce, until today at $2,700 an ounce. Over that period of time, it's had a compounded annual rate of 9.5%. There's hardly any investment, in fact, no others that I'm aware of, that have that track record. And now, of course, when I started writing the letter in the 90s, I didn't know it was going to have that kind of track record. But gold is money, and it's been money for thousands and thousands of years. I like to tell a little story about how I got into the business. And I can use this 1 ounce silver gold coin that my grandfather gave me in 1971. I was in graduate school at the time, and my grandfather was a skinflint, New Hampshire person who never had a mortgage, never owned a house because he had friends who went bankrupt in the Depression, and he was afraid of making the commitment to a mortgage that would, that end up ending like his friends. So anyway, he gave me this coin in 1971. Nixon had just set the gold price free. And he said, John, I was visiting him on Labor Day weekend. And so it was a couple of weeks after the Nixon set the price free. And he said, John, I want you to have this. Now, $35, isn't much now, but it was a lot back then. And it was a lot to him because he'd always been a school teacher or a school principal, didn't have a huge income, no retirement, and other than whatever meager Social Security was. And he wanted me to have this, and he said, hold on to it. It'll be worth a lot one day. Well, story end. It's true. It's now worth $2,700, this coin, and I'm happy to have it. It's the date on the coin is 1896, the year of his birth. So that got me interested in gold, as an investment. And as I wandered off into the ivory tower of teaching for 20 years and working in instructing people and thinking about it, I got to thinking that there's a market for good analytical writing in this business because it's a unique business. Every miner produces the same thing. Now, there are ways to tell where the gold came from, but doesn't make any difference to the buyer of the gold. The way that you look at the stocks is completely different. The stocks have two completely different capital structures, different cost structures, different management skills, different locations, different cash flows. So all the mining companies have the same thing to deal with. They have the gold price, whatever that is. And then within that, they have to figure out how are we going to exist. So I thought that was pretty unique because it's not like trying to decide Coke versus Pepsi. They all have their secret ingredients or whatever. They're all dealing with the same uniform market price. But if you go behind that market price to the companies themselves, there's huge differences. And some companies are very profitable. Some companies are not profitable at all, but they still exist. So,
right. And I'd like to come back to some of those questions in a little bit. So basically, guys like some of the folks who you mentioned, and some of them are unfortunately no longer around, people like Harry Brown and Jim Dines, and gold because some mystical reason, which happened to turn out to be right for a lot of their people, but their analysis was maybe lacking, or there wasn't even any analysis.
Well, I remember one gold writer who's no longer with us either, not any of the big names, but one of his ways of evaluating a gold mining company was whether or not the management went to church on Sunday. Now, that's a very noble thing that people could do, but it's got nothing to do with the company as an investment. I don't think so. They hung out at a bar in the basement of a building in Vancouver.
They needed it, though. When you were what years were you at Columbia?
62 to 66.
Okay. And do you remember any of the people who were teaching economics there then?
Lowell Harris and Peter Kennan, who was one of Kennedy's advisors, and some other guys, I guess.
Okay. So I've never heard of those guys, which is no disparagement. I just haven't heard of them. But when I was in school, except for the wonderful time that I got to meet Friedrich Hayek, I don't think I met any economists who understood inflation or understood money or understood gold. And I'm guessing that Columbia was the same way. So was there something in your education or your research that, other than your dad giving you the gold coin, that kind of helped you understand, hey, they're getting this all wrong? When Keynes said this is a barbaric relic, he just didn't know what he was talking about?
Yeah, no, I don't know. I guess it's like getting religion. It comes to you slowly over time. And, when my grandfather gave me that coin, I definitely wasn't a gold bug. I was still in the learning stage of my life, and I thought it was a nice gift and pretty, and I'm happy to still have it. And it wasn't until I'd been involved in teaching, really, and you learn a lot teaching because of the questions people ask you. And the students don't really know anything. They ask questions that you might think don't make sense, but then sometimes they really do make sense. And so when you're talking about economics and money, now you're talking about the basic thing that everybody needs. It's a medium of exchange. How do people exist in the world without money?
Were you teaching during the 70s when we had that first post Nixon, or I should say post shutting the gold window inflation? Were you teaching then?
Yeah, I was. Yeah.
Did that get you interested in gold yet, or still not?
I don't know. I don't know if it was the 70s or maybe by the end of the 70s, and when gold ran up to over $800 in 79, maybe that's what sparked my interest in it as an investment, not necessarily as something that you should make as a key part of your life, but it's a way of taking care of your money. And the fact that gold went from $35 to $850 in 79, that was a pretty good move. So I got interested in that, but I always like stocks better than the metal because the metal, you have to got it, how are you going to store it and what? But I believe in owning the metal, and I own quite a bit. Some in the safe here, more in the ETF, the gold ETF. But in any case, trying to figure out which stocks to buy really became the focus of my investing work. And as you know, as a subscriber, that's really what I write about. I don't preach to people that they should own gold. I assume they already have an interest if they're buying my newsletter.
You mentioned earlier people like Harry Brown and Jim Dines, and I remember there were guys like Harry Schultz and Jim Blanchard and Richard Russell and a lot of those guys who were very prominent newsletter writers. Did you read those guys? Were you influenced by them to any extent?
Incidentally, I didn't consider any of them analysts.
Uh-huh.
They basically preachers and extolling the virtues of gold, and they were right. But that didn't tell you what stocks to buy. They didn't tell you where gold was going to go in terms of its price. They would just say it was kind of that gold, guns, and God kind of movement that said that was the way you should run your life.
Uh-huh. So were there any other people from the industry or academia who kind of have influenced the way that you think about gold and the gold mining industry?
Well, my father was a Harvard PhD.
I didn't
But
realize
he had no interest in gold at all. And when I got started, he reminded me about Mark Twain's famous admonition. He says a gold mine is a hole in the ground with a liar standing next to it. And as I found out over the years,
that's sometimes true, and in some cases, not even a hole in the ground.
it's a future hole in the ground.
Tell us just very shortly about your dad.
Well, he was a professor at Boston University, and he actually wrote his PhD from Harvard, and he was kind of a New England conservative. It was his father that gave me the gold coin.
It was your grandfather. So he had it from when it was legal before Roosevelt.
Yeah, well, the coin was, I don't know when my grandfather got it. It was from his birth year, but 1896. But I don't know when he got it. But my father was more of a Keynesian. That was the place to be, I think, back then. And he was a product of the Depression. And how do you get out of the Depression? You flood the world with money to get people to spend it.
Yeah. So we're talking about gold. So silver, often I've heard it called poor man's gold. How do you think about the investment potential of gold as compared to silver?
Well, silver I don't see as a monetary asset. Yes, some central banks have a little bit, but there are very few pure silver mines. Most silver comes as a byproduct of production of zinc or lead, or zinc and lead, or as gold. Silver is a byproduct of some gold mines sometimes. So it doesn't have the respect for the miners that gold does. And in fact, the silver miners themselves have all gone to gold. You look at Coeur d'Alene or Hecla or even First Majestic Silver. They all bought gold mines because they saw that was a bigger market, I guess, for their stock. And there aren't very many good silver mines out there because they're a byproduct. It could be a good silver mine, but it's really a copper mine. And so it's hard to find the right silver stocks to own. We did, when I wrote Gold Stock Analyst, we had a newsletter called Silver Stock Analyst. And, we covered about 30 stocks. There's more liars standing next to a hole in the ground in the silver business than there is in the gold business.
Uh-huh.
And that's just because of the nature of the metal. There's just pure silver mines, silver deposits.
So, John, from an economic point of view, my understanding, and obviously I'm sure you have better understanding than I do, but my understanding is if you look at, well, we know supply, gold is mostly existing supply, new supply is what, 1 or 2% per year.
Yeah.
Silver, the supply side, as I understand it, is much more variable. Is that much more important as a percentage of total available supply? Is that right?
I'm not so sure. It's very hard to measure the supply of silver because until recently, silver's $34 an ounce now. When gold price was set free, silver was $1.55. So if you look at the annual compound rate of growth of silver, it's 6%. Nothing to sneeze at, but it's a lot less than gold's compound rate of growth. I think that it's an industrial metal more than anything. But some people do treat it as gold's poorer brother. But remember, there's only been 2 real spikes in the silver price. It's been when the Hunt brothers tried to corner the market in the 80s and drove it to $50. And then in 2012, they went to $50 again when gold was having its boom then. And I think that was really a reflection of the poor man's gold because it was a lot cheaper to buy silver than it was to buy an ounce of gold.
So if we compare it to gold, my understanding is gold demand, the largest single demand for gold is jewelry. And the second is central bank monetary holdings. Is that your understanding or am I wrong?
Yeah, thereabouts, yeah.
And is it your view that the jewelry holdings are sort of like quasi-traditional money holdings? Is that why people own gold jewelry?
No. I mean, maybe some. It depends on the jewelry itself. In Asia, the jewelry market is very developed, but it's really it's low grade jewelry. It's nothing that you would want to give to your wife, other than for its gold content. It's just, the gold chain is a way to keep track of the gold itself.
Yeah, that's my understanding, which is really quite kind of, in my view, quasi-monetary. Which
yes.
I think. So people talk about, and we didn't talk about this before, but when people talk about Bitcoin, and some of the advocates of Bitcoin that I've heard say that obviously they talk about the fixed supply, and I don't know whether it is or not, but that's what they say, and let's just assume that's true. But do you know Steve Hanke?
I know of him. No.
So he makes the point that with Bitcoin, since supply is fixed, all the change comes from demand, 100%. And there's with gold, with all the monetary metals throughout history, there's always been some other source of demand besides monetary demand, which to me, as an economist, seems like a good thing because it's going to tend to stabilize the price. Does that make sense to you, John?
Do you want the price to be stable?
Well, in the case, you do if you want it to be money.
Yeah, okay.
I'm talking about where you and I might not live to see it, but this fiat money world, who was it, McCracken or somebody, or one of those guys in one of the administrations, if something can't go on forever, it won't.
That was Schultz.
Okay, but I mean, every fiat money, every paper money in history that anyone has ever studied eventually went out of business, right? Went to zero.
Well, you can argue the dollar has gone out of business now. I mean, the reverse of the gold price going from 35 to 2,700 is the dollar has gone down in value. What's a dollar worth, in 1971 terms? What's a dollar worth now? 3 cents or 2 cents?
Right. But the question is, will it ever actually stop functioning as a medium of exchange? And if we look, I mean, we're kind of in uncharted territory, right? Because before about either 33 or 71, however you want to call it, there was never a time in recorded history when there wasn't real money, right?
Well, yeah, and it always was gold at some form,
Mm-hmm.
back, back whenever. Yeah, but gold is not really a convenient currency. That's why, paper money got developed now. Yeah, but that has the same problems to me as Bitcoin does. Bitcoin you're using is a broad classification, but look at all the alternative coins there are now. Maybe Bitcoin is a fixed number, but that doesn't prevent new ones from coming in all the time. They gain some level of acceptance among people. Um, so I think that the Bitcoin is really not an inelastic supply. I think it's elastic as a classification of.
That's a really great point. I hadn't thought about that before. That is a great point. Let me bring it back a little bit more to the gold stuff. As I subscribed and read Gold Stock Analyst, I mean, you don't need to hear this, but you already know it. Fantastic work. And as far as I could see, unique in that whole space, where I don't think if there's somebody who is like the number 2 analyst, I don't know who that would be.
Well, I don't know who either, but one of the things, it's really not that difficult. I mean, the data is all there. You just have to crunch it. And not people would rather write their letter sitting at their desk or on an airplane on their laptop computer, blah, 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 without much analysis. But my whole thrust was that these, as we've already said, that these guys all make the same thing. So let's figure out who's a good buy and who isn't a good buy.
So I want to ask you, John, about if your thinking changed or your perspective or what, because when you had Gold Stock Analyst, you had the top 10. And if I'm remembering right, typically there was 1 or 2 royalties, a bunch of some of the producers, and then maybe a couple of explorations.
No exploration, but some near producers.
Near producers.
Yeah. I'm not a geologist, so I can't really evaluate drill results.
Right. And so what I want to ask you is now you have favorite 5. I assume that's what Fave means. But it's only 5. And I read the part 100 times where it said, buy all 10 of these. Don't just buy one. So did something in your thinking change or something in the marketplace? Why 5 now and not 10?
Yeah. Well, a couple of reasons. One is my time horizon changed. When I was writing Gold Stock Analyst, I had a much longer time frame to deal with.
Personally,
yeah.
Uh-huh.
And so it meant that I could tell people to invest in stocks that maybe have a longer time to mature. Good investments, good place to get in now, but it may be 3 or 5 years out that the real maturation is going to come. And second, when I came out of retirement earlier this year, I went back and I looked at, audited, still to my knowledge, the only newsletter in the world that's audited, has audited results, that every trade, every change in our recommendations is tracked by our auditor, whose phone number is on the audit. Anybody can look at it, it's on our website, and call up Mike Holtzapfel and to say, what about this guy Doody? I went back and I looked at 23 years of audited results, and I said, well, what were the best stocks each year? And I went back and I said, well, suppose you look at the top 5. Now, it wouldn't necessarily be the same every year, but suppose the top 5 stocks in each year, how do they do? So the top 10 on an audited basis did an average gain of 19.3% a year. The top 5 had an average gain of 47.8% a year. So I said, maybe I can be smarter. I've been at this a longer time. Maybe I can pick the best 5 stocks. And that became the genesis of the kernel of idea for the newsletter, the favorite 5. And that's what I try to do. And I don't know if you want me to talk yet about the newsletter, but my approach was basically, to look for 3 things. One was I wanted to be in a stable political environment. I wanted to be certainty of title. I don't want to be in West Africa where the governments keep trying to squeeze more money out of the miners, or in South Africa where the government now owns 26% of every miner. I wanted to be in the United States or Canada or Australia or Chile or some places where you have a certain title. And second, I wanted data. I wanted to know what you really had in the ground. So that meant the company had to, if it wasn't in production, had to at least have a feasibility study, something that were independent experts that looked at the drill data and calculated the grade, the average grade to be mined, and the cost to build a mine and the production costs and everything, and said, yes, this mine is going to make money. And it's going to make enough money it has to be a hurdle rate for making money. The SEC says you can have proven and probable reserves if we make 1 cent after 20 years. But that's not good enough for investors. We need some kind of a larger rate of return. So, and third, I wanted to be able to take that data and calculate an operating cash flow multiple, a way to compare the operating cash flow that these miners generated versus the other miners. And so that meant I had to develop a data system, which was really just an extension of what I was doing with Gold Stock Analyst. And right now, the average operating cash flow for a miner or a near miner is about 6 times operating cash flow. Now, operating cash flow is a number I should define. It's the gold price minus the cash cost to get the gold out of the ground, the cost for labor, for power, for materials, for cement, and whatever the miners need to get the gold out of the ground. That's the operating margin. And if you multiply that times the number of ounces produced in a year, that gives you the operating cash flow. So there's nothing, you can't cheat the labor. They're not going to come to work if you don't pay them. And so and there are other ways to define the cost of an operation, but you got into more management decisions. And I want the actual nut. And so the average operating, and so if you take that number, the operating cash flow, and you divide that into the enterprise value of a miner, the enterprise value is simply the market price times the number of shares. You adjust for debt and adjust for cash, and you get the enterprise value, and you divide that by the operating cash flow multiple. Now we have a way we can compare every miner. And the average operating cash flow right in the industry right now is around 6x, but it ranges from under 1 to 10. And over time, it's had a tighter range. Over time, it's had a range of 4 to 8 kind of thing. So we're around 6.
So over the years, I know, like you said, these are holes in the ground with a liar standing next to it. And obviously that's one risk. And as I was thinking about this and preparing to talk to you, I came up with 5 kinds of risk that it seemed to me, and I'm sure you have others, and I wanted to kind of ask you about them. And then have you gone back and say, okay, we've been doing this long enough. We have a track record and we got 19% compounded, but included in that, and I know because I had some of them, there were some some zeros in there, right?
Yeah.
And so going forward, was there something we could see, oh, we should have put more weight on that risk? And so the 5 that I identified, I'm sure you have others, is political, geological, which I guess grade is a similar thing. It's right. You thought you had a higher grade and you didn't.
Yeah.
Like financing risk, which is somebody runs out of money and now all of a sudden you're getting horrible terms. And operating risk, which is just, it's strikes, it's natural disasters, all that kind of garbage. And you probably have a list of others. Which of those are the most costly if we look at history? And how do you think about looking forward?
Management is the biggest risk. The quality of management in this industry is not good. The guys who go into mining are not the sharpest knives in the drawer. And they tend, basically it's an earth moving business. And so I mean, the good people. I'm not talking about the quality of the people, but I'm talking about the brain power of what they're doing. And the earth moving is building roads and building mines, about the same thing. And you have to understand these guys. And the way you get to understand them is you visit the mines. It's very difficult to do that as an armchair analyst. And you spend time with the actual mining management. I don't anymore, but I went on lots of mine trips. I found that not only taught me a lot about mining, but I found that as a way to sort of begin to differentiate between miners. And, of course, you want to avoid the ones you don't think are good miners. So basically, all the risks that you mentioned are there. I mean, the political risk, I want to avoid that altogether. And you can have political risk even in good mining countries, like at a company, Belo Sun, had a site, still has a site in Brazil that's going to produce ultimately a couple 100,000 ounces a year. And it's got a good capital cost to build the mine and all that. It's very profitable. But they've got some kind of a local politician there that's adamantly against that mine. And he's been able to single-handedly stop that mine from being built. Even though it had a construction permit and everything necessary, all the judges aren't uniformly mining interested in Brazil, although Brazil's a very good mining country. You'd like to be in Brazil. So,
and First Quantum, didn't they just get basically their mine taken away from them in Panama recently?
yes, well, they had a big copper mine, and actually that produces gold and silver as byproducts. The copper mine cost almost $7 billion to build. It's in Panama, and with the change in the Panama government, there was some kind of a study that was done that showed that they didn't properly get the permits. Now, that's a question of whether or not, a question of interpretation, but First Quantum was shut down. That mine, First Quantum has other mines, and Franco-Nevada, the best royalty company, had a huge royalty on that mine and the mine still is shut.
Yeah. And if my memory serves, John, I'm pretty sure that we had a loss in Montana from political risk.
Canyon Resources.
And okay, you remember the name. I guess it was
Hurt me too.
And California, that little one in like Mojave area. I can't remember the name.
Yeah, Golden Queen. That's actually producing now, but it took them a long time.
Well, that was maybe management risk because they basically took it away from the shareholders, didn't they?
Yes, yeah, they got some hedge fund guys from Boston involved.
Yeah. So yeah, no.
Well, that was one of the reasons to have 10, because if one blew up, you
right,
still have 9 good ones.
Yeah,
potentially.
Yeah. Do you use I think I read in the fine print somewhere that the total universe of companies that call themselves gold mining companies that are publicly traded is something close to 1,000?
Yeah, if you could consider all the markets in Canada and some of the European markets, there's probably about 100. When I first started, there was no information that you could get on a lot of these stocks. So I bought 1 share or 5 shares, whatever it was, and this is back when you had to pay a commission,
right,
in the 1990s, and so I forget what my cutoff was, but if I could buy 5 shares for $5 or something like that, I'd do that. And the point is, I wanted to get the quarterly and annual reports. The
right.
SEC wasn't really sending out information. The companies might fax you information if you asked them nicely, but they had to send this stuff to their stockholders. And so that was my basic. And I bought shares in about 80 companies. I've got a stack of certificates, of companies that are out of business. But that was how I, began to build my first database, is to get data from the companies themselves.
Uh-huh. So today, you think there's 80 or 100 publicly traded that aren't like a penny stock on Vancouver? Is that what you're saying?
No, I think it's more than that. If you count the penny stocks of the companies you could look at, analyze, there's about 30
in the whole universe.
Well, I want.
Or is that after you've thrown out South Africa and after you've thrown out all these jurisdictions that we don't like?
Yeah, and for example, I don't cover Australians because they only report twice a year, and the information flow is horrible. That doesn't mean the mines aren't good, and it doesn't mean the management isn't good. But as an analyst, I can't look at them because there's no flow of information. So it boils down to about a universe of about 30, and that I study. And I don't report on all of them. There's companies that I don't cover in the newsletter. I cover about 25 in the newsletter, but there's others that I'm following. And either when an opening comes up for coverage doesn't mean I'm going to recommend them. That's one thing that's unique about the way that I work, is I study companies that I don't recommend.
Right.
That's how do you understand when somebody tells me a company is undervalued? How do you know unless you know what the average values are in the industry? There's every analyst, oh, this is undervalued. Well, where's your data? Where's the data that says this is undervalued?
Do you have, so Barron's used to publish, I don't know if they still do, they used to publish their miners index going back to, I think, the 60s.
I think they still do.
Uh,
Barron's used to have a gold interest. I mean, my first interviews were with Kate Welling, who was one of the writers at Barron's.
I didn't know that. And I think by some of those measures and yet by lots of other measures, gold stocks just seem as a universe very cheap to where they have tended to be at times in the past. Does that make sense, or you don't agree with that?
No, well, the GDX gold index, which is the biggest one. It's the ETF that owns about 60 stocks. That's
Yeah.
an index. And, I guess it's somewhere in the low 40s now, and it's been in the 20s. Those indexes have too many stocks in them. You don't want to own a doggy company and still get in the index. So I don't
Mm-hmm.
want to own stocks that are dogs. The average growth rate of the GDX index is about 3% since it was formed in the mid 2000s, like 2005 or 2006. And that's because it's way too many stocks in it. There are so many dogs. And part of that is the SEC's fault. It says you've got to have the prudent man rule. You've got to have 30 or 40 stocks in a portfolio if you're going to be minimizing risk. And that doesn't work in the gold stock. It may work in the general stock market, but not in the gold, because there aren't
Uh-huh.
30, 40 stocks worth owning.
Right. Okay. And has the industry done so badly because they're poor capital allocators?
They bought companies they shouldn't have bought. There was a trend in the industry 10, 15 years ago to buy production. And thinking that, well, if we have the production and the gold price goes up, we'll be all set. But the production didn't materialize as quickly as they thought. Ty Burt spent $7 billion on a company in Mauritania, and only now, the mine's now owned by Kinross, and only now is the mine finally running properly after 10 years of wasted money and billions. Now you would buy it. And Kinross is a great stock. I love the stock because it's the biggest major that's worth buying.
Kinross, yeah. Barrick, the ones that bought Cerro Casale like 20 years ago and never did.
And they put Arizona Star in that. That was my number one stock pick over time. I guess it went up like 3,000%, and from 50 cents to like $18. But the mine is still not built.
Right.
And I've
And
been there. I've been there 14,000 feet up in the Andes where you can hardly breathe.
what is the thought process, if you understand it, of because they spent billions on that, as I recall, didn't they?
Well, maybe 1 billion. Because the capex back then was a lot less too than it would be now. And Barrick doesn't, I don't know if they owned 75% or 100% of it, because Goldcorp owned a part of it and then Newmont bought Barrick. So I think Barrick and Newmont have some kind of a partnership in it. But it's very difficult to build a mine at that kind of altitude because typical miners can't live there. You got to get people who live up in that area that were used to breathing that rarefied air to work in the mines. And Barrick found better opportunities elsewhere.
It just seems like a lot of money to spend. And then
Different management, though. Yeah.
let me ask you another historical question that you may have studied, maybe you haven't. Did you ever compute a turnover rate while you had the top 10 in Gold Stock Analyst for 30 years? You ever compute a turnover rate?
Oh, it would be 2 to 5 stocks a year. Either they would reach their target. One of the things I do was I give you a target price, and either they would reach the target or they would get bought out. Because I was always looking for undervalued stocks. They have a potential of getting bought out, and I suppose that 2 to 5 would be a guess though. I never did an actual study because I don't know what that teaches me other than
Right.
how to answer the question.
So is it the case that taxes, like capital gains taxes, didn't really figure into your hold or sell?
No, I don't know how they're owned. You have it in your IRA or I just can't include that.
Yeah. Yeah. I maybe it doesn't belong here, but I we do a lot of work in when you own it in a taxable account, when you not just gold stocks, but anything. But we can talk about that offline. So I want to again move to a different topic, more personal. So you, as I understand it, remember 5 years ago or so, you sold to Stansberry.
Stansberry, yes.
And did you have a 5-year deal with them, or did they change their mind?
Yes, I had a 5-year contract to keep writing the newsletter, and they honored that. You know, when the 5 years was up, the first couple of years were very good. You know, Stansberry we had a very good relationship, but you know, their whole raison d'etre is to get the upfront money from a subscriber, and they allocate that over the life of the subscriber, but they've got the money rather than the subscriber has the money. When I first started writing the newsletter, and really until the very end, I always had an annual fee, whatever the annual fee was. That's what, if you join, you pay the annual fee. But the newsletters, particularly the successful ones, they all get a big upfront money. And I've done that with Fave 5. It costs you $2,500 to get that, because you're getting not only the current issues, you're getting the back issues, and it takes 5 issues to cover the 5 stocks that we recommend now. And back then, you know, Stansberry said, listen, you're recommending 10 stocks. People start out with the knowledge of all those 10 stocks. They don't, you know, some newsletters just tell you what they leak out a stock a month kind of thing. So it takes 10 months to get a whole portfolio. But so Stansberry, the first couple of years that I was with them as an editor and on board, they had very good success, and then the investors lost interest in gold. And you know, Stansberry had thousands of subscribers, and there's still is a big company. Yeah, but Bitcoin came along, and I think that stole some of the investor interest. Gold is an old man's investment. We lost a lot of people just because they passed.
Oh, okay.
And I don't have the numbers on that, but you know, we were getting emails from saying, please discontinue, you know, sending the newsletter because John Smith is no longer with us, and well, he loved the letter, you know, I'm his wife and I don't understand it or whatever.
Did they not really promote it?
Well, they did, and the first couple of years they were great, but I think that you can't promote something to people who don't want to buy.
Mm-hmm.
And I think that the interest in gold, it narrowed over time because Bitcoin took away some of the buyers who would have been gold bugs, and they became Bitcoin bugs. So it's a smaller market now.
Okay. So you had a 5-year deal, so you were planning to retire anyway?
Yeah, well, I turned 80 at the end of last year, and that was the end of my 5 years. And so I retired, and I got some very nice compliments. People wrote in and blah, blah, blah. And my intent was to ride off into the sunset. And at that time, last year, gold averaged about 1940 an ounce for the year. And at the end of the year, it still hasn't cleared $2,000 an ounce. Stansberry made an attempt to keep it going under my associate editor, but he decided he didn't want to do it. He wanted to do his own letter somewhere else. And so he did that. And so they ended up folding the newsletter into into some other letter that wasn't really interested in gold and wasn't interested in doing the analysis that I was doing. So when 2024 opened up and gold finally peaking above 2000, and maybe by April or May, it was a couple $100 higher than that, 2,200, 2,300. You know, I was doing the same work for myself, but I was focusing on 5 stocks. So I said, you know, people are asking me. I mean, it was really nice when you get somebody finds you, they Google me, find me, and send an email. You know, why can't you keep publishing the newsletter? Blah, 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 blah. You know, it was great. And so I decided to do it again. And you know, Doug, my web guy from years ago, was still available, and we had a lot of the data. So we got back into the business, but I decided to focus it on favorite 5, and I'm looking at a shorter time frame. I want these favorite 5. I want companies that can have a jolt. Something could happen to the company that could really drive the price higher, not just because gold is going higher, but because something could happen to the company. For example, I'm not going to give you the name, but one company had a portfolio of 4 mines, 3 in the US and in Peru, and 1 in Turkey. And the Turkey mine was an open pit heap leach mine, and they had a pit slide. The pit just slid, and the best precautions were taken on safety, but mining accidents happen. And a number of workers were killed. Half a dozen workers were killed by that. The stock, which had been $15, immediately cratered to $5. And yet the other 3 mines are producing very profitably, operating very nicely, and there's a lot of value left. Now, we don't know whether they're going to be able to operate that mine again in Turkey. I think they probably will, but I'm taking all of the value out of the company. I've said the mine is never going to operate again. And I think that, it's a $5 stock, but it's if you never heard of that mine that had the accident, it's a $15 stock. So I'm looking for companies that when they solve that issue, I think the government will let them reopen that mine, if nothing to recover the gold that's already out of the ground and just waiting to be run through the mill. That'll generate like $700 million. And that money could be used to pay the families and give some kind of a big payoff to the workers. And then another mine was confiscated by Kazakhstan. And I would never own a miner in Kazakhstan. The government took it away from them. But the company was clever, and they'd taken the money that had come from Kazakhstan. They'd invested the money back in the U.S. and Canada. So they have a core of good mines there that are producing and making money. And yet the market still sees it as being a Kazakhstan expropriation. So companies like that I like, because ultimately that incident is going to wear off, and the owner of that stock is going to own it at a very low price. And the value of the remaining mines is going to come to 4, and it's going to be a good investment. Now, is it 2 years or 3 years that's going to happen? I don't know, but that's a better investment. You already got producing mines in the company's portfolio, and my time frame at 80 is much shorter than it was when I started the gold stock 30-something years ago.
Right. No, I get that. Although talking to you, you certainly don't sound like a guy who's retired in any sense.
I didn't really, but 5 years was up, and
yeah.
kind of on.
Any thoughts, given your experience of retiring and then unretiring, that you might share with other people who are in a similar stage of life in their 70s or approaching their 70s or 80s? Any thoughts?
Well, I think your work should be a hobby. And if your work is a hobby, now you can't do that if you work on a factory floor or something like that. But if maybe you work in some kind of a business that has wider expertise. If your work is a hobby, if you're a hobby business, so to speak, I think you should keep going. Maybe you reduce your 10 stocks to 5 stocks. Maybe you do something a little less. Maybe you travel less, whatever. I don't know what. But there may be a way to continue on, because I think that keeping your mind active is what keeps you alive. And if you're going to retire and play golf, sayonara. That's the end of it, really. The beginning of the end, anyway.
So is your thinking now that you'll do this as long as you can?
Yeah, well, 2 or 3 years. If the gold price is, gets to 3,000 and doesn't do anything for a couple of years, maybe I'll retire then. I still have 3,000 as a target. Yeah, but we'll look at that. I promise everybody at least 2 years.
Oh, okay, I see. Got it. Yeah.
Or we're half a year into it. So.
Right. Are you enjoying it still?
Yeah, I do. I like what I do. So, I like the people. I found good people in the industry. There are good people in this industry, and not always good things happen to them. That's the nature of the geology or whatever. The Franco-Nevada people are terrific people, but the geology of that mine in Panama was great. It was a political aspect but I think that mine will come back.
I asked you a little bit about retirement. If we go to the other end of the spectrum, and I know you said gold is kind of like an old man's thing, but you also said it's been around for 3,000 years, and I doubt if it's going away. So do you have any advice for, say, an aspiring analyst in his or her 20s? Anything that you would think that they should do or shouldn't do? Any credentials, MBA, CFA, anything like that you think is worthwhile?
Well, for workers, the industry is starved for mining workers. And these are very high paying jobs. $100,000 a year is normal pay. So I think if you're a worker type, not a management type, you should look at mining. And maybe it's not the clean hands business of computers, but it's high paying and there's a demand for actual workers. Now, in terms of what you should study, you could be a mining engineer. You could study mining. There are still good mining schools around. When I was at Columbia, my introduction to geology was taught by the School of Mines. Columbia had a School of Mines back then. This is in New York City, and I guess they got people that worked in this and building the subway system. There are fewer colleges now that offer degrees in mining, but they're still around. They're all out west. Colorado, Canada has good mining schools, the Queens College, but you got to find something that interests you. And I'm not the best example of that because my interest in gold came late in life. It was stimulated by my grandfather, but it would never really blossomed for 20 years later.
Yeah. Given your perspective, how do you see success? What is success to you?
Oh, I think it's living comfortably, finding a niche that you're comfortable with personally, having a good wife. I've had a couple that I got a good one now. And giving back. I put 4 nieces through college. I've got 2 in the bullpen still to go. I found that, and they've all done well. I mean, they didn't go to college because they had a free ride and just smoked pot and drink beer. They've all got good jobs now. One has just passed the bar. Of course, not that the world needs a lawyer, but that was her choice. Yeah, so that's good, and I think it's important to try to live a good life. I'm not a religious person, but I'm a spiritually good person. I think don't do unto others as you wish to have them do unto you. And I think that's a good credo for anybody going through life.
Yeah. You've got a lot of life experience, a lot of success. With all that success, at this point, what's your biggest challenge?
Staying alive. No, my health is actually very good. I'm very lucky on that. My intent had been to write a book because I think that there's a lot of investing knowledge and mining knowledge that I could bring, and I still will do that ultimately. But instead of writing the book, I decided to impart that through another newsletter. And one thing I got a lot of feedback, particularly when I retired, is that people said, I learned so much about mining from you. I mean, you don't get this kind of stuff about mining analysis and rules of thumb. For example, that a mine gets built not because you found some gold in the ground. You have a gold deposit that's going to be productive and it's going to produce for 10 years. It's the rule of thumb. If you can develop reserves for 10 years of production, this might be a mine worth building. But so the fact that some mines have 1 year of production and they're going to keep looking, well, that's not a company that interests me.
Right. John, where can our audience go to learn more about you, learn more about the Fave 5 newsletter?
Well, you can Google the name, John Doody's Fave 5 Golds, or just Google my name. You'll get plenty of hits, and it's enough unusual name that you won't get. It's not like a John Smith name.
Right. All right.
Thank you for listening to another episode of Sterling Insights, Stand Out and Supercharge Your Assets, where we provide the info you need from successful leading financial advisors, lawyers, and CPAs. Your hosts, Roger and Catherine Silk, invite you to learn more about Sterling Foundation Management by visiting sterlingfoundations.com.